So the Pearl Harbor attack happened on December 7th, 1941. If we look at the one-day performance, the S&P declined about 4%, 3.8% over one day. The maximum decline following that was 19.8%. So about a 20% decline happened. And that happened 143 days after the attack on Pearl Harbor.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. I've been receiving some questions about how Russia's invasion of Ukraine could impact the stock market and what it could mean to your retirement portfolio. So today I wanted to talk about that, and I want to talk about three things: what the current state of the market is, how the stock market has performed during past wars and invasions, and what you should possibly be doing with your portfolio. So the first thing, the current state of the market. So we talk about the markets. We can talk about different ways of measuring it. The Dow Jones average is one. The S&P 500 is another. And I think it's easiest to focus on how the S&P 500 is doing and how it's done, as we have data on the S&P going back to 1927. If you wanted to use Google, you could type into Google historical performance of the S&P 500, and you could easily find that information. You don't need to sign up for some fancy program or anything. It's out there. And so if we talk about where we are, currently the S&P 500 is down 9.5% year to date. We're approaching correction territory, which is a decline of 10%. If we look at how it did the last 3 years, in 2021, the S&P returned 26.89%. In 2020, 16.26%. Despite COVID, in 2019, 28.8%. And in 2018, it declined 6.24%. So it's probably to be expected to see a little bit of a decline in the S&P 500 because it had been 3 years since we finished out the year. Now, there's been declines during the year. They call that an intra-year decline, where the market has declined. Or during COVID, the S&P 500 declined about 30%. So there's been declines during the year of more than 10%. But as far as closing out the year, we haven't seen one of those negative years in 4 years. So next I want to talk about how is the S&P 500. And a reminder, again, for those who aren't familiar, if you're a new listener, the S&P 500 is a measurement of the U.S. stock market. It represents the 500 largest companies in the U.S. So it's a good mixture of how the U.S. stock market is doing. And if we go back and look at, I've identified 5 events that I wanted to focus on and how the S&P 500 performed during those events. And those events are the attack of Pearl Harbor, the Iraq's invasion of Kuwait, the U.S. bombing of Iraq, the start to the war in Afghanistan, and because we're talking about Russia, Russia's invasion of Crimea. So the Pearl Harbor attack happened on December 7th, 1941. If we look at the one-day performance, the S&P declined about 4%, 3.8% over one day. The maximum decline following that was 19.8%. So about a 20% decline happened. And that happened 143 days after the attack on Pearl Harbor. It then took 307 days for the S&P 500 to recover all the way back to where it was on December 7th, 1941. And if you measure the performance of the S&P from 6 months after, and the way I'm measuring this performance is by looking at the total return of the S&P. So that's the price of the S&P 500 plus the dividends that the S&P 500 pays, assuming those were reinvested. Those are all the numbers that I'm talking about. And this information, again, is available online. I have some sophisticated tools, but for this, I use Yahoo Finance. If you type in daily performance of the S&P 500, you can find right on Yahoo Finance, you can put in the dates that you're looking at, and it will give you the valuation. You have to do the hard work of actually calculating the performance because you can't easily do that, but you can find what the S&P 500 was worth. Just to put it into context, the S&P 500 was worth $9 on the start of Pearl Harbor, whereas today, the S&P 500 is worth $4,281. So that's a tremendous amount of growth and inflation that's taken place. But looking at that 6-month return, the S&P 500 was down 15.34%. 1 year after Pearl Harbor, there was no change to the S&P 500. It had not lost anything or gained anything. But if you had not sold your S&P 500 investment and you had held it 5 years later, the total return would have been 65%, 64.30%. Let's then focus on Iraq's invasion of Kuwait. That happened on August 8th, 1990. That one day, the S&P 500 declined 1.1%, so very minimal decline. The maximum decline or maximum drawdown was 16.9%, and that happened 71 days after Iraq's invasion of Kuwait. It took 189 days after Iraq's invasion of Kuwait for the S&P 500 to fully recover back to that level, and your 6-month return of the S&P 500 would have been -1, but your 1-year return would have been 10%. So if you did nothing during the Iraq war, you didn't sell your investment in the S&P 500, it would have been up 10% 1 year later, and 5 years later, it would have been up 58.97%. We'll focus on one more here, and we'll focus on I mentioned 5, and I will share in the show notes a link to this data, or at least the report I created from this data, where you can see how things have performed. So let's just look at the Russian invasion of Crimea, and that happened on February 20th, 2014. The one-day decline of the S&P 500 was negative 0.2%. The maximum decline was negative 0.2%. So the S&P 500 didn't really decline much due to Russia's invasion of Crimea. So the bottom from that event happened 1 day later, and it took 1 day for it to recover. 6 months after the invasion of Crimea, the S&P 500 was up 9.47%. 1 year later, it was up 17%. And 5 years later, it was up 51.36%. So I kind of think you're getting the point of what I'm getting at here, that these events, and there's many more of these, that you could easily look up, many times don't have a big impact on the performance of the S&P 500. You would think, well, if Russia invades Ukraine, which they already have, they claim they haven't, but right, they've essentially recognized 2 provinces as being their own countries, that will drive down the markets. And if we go into a full-scale war with Russia, then yes, I think there's a possibility that the markets could go down from here. But we're already entering this having the S&P 500 down 9.5% on the year. So things have already declined. And what the markets care about is they care about the profits of the S&P 500. That's what the investors care about. That's what drives the markets. And so far, what happens is after the quarter is over, so we've ended the fourth quarter, companies report their profits and how they actually performed. They give estimates before then, but then they go and report. And that's what the markets trade on. So far for the fourth quarter of 2021, this was as of 5 days ago, I found some information from FactSet. 84% of S&P 500 companies have reported, and of those that have reported, 77% have reported a positive earnings per share surprise. What that means is that those companies have made more, 78%, than they estimated they were going to make. And 78% of the S&P 500 companies have reported a positive revenue surprise, which that means that in addition to having earned more, they actually had more of a profit in the company because of the fact that they're able to maybe cut costs or whatever they were able to do, even despite some of the issues we're seeing with COVID. So that's what the markets care about. And it's possible that if we do go into a prolonged war with Russia, hopeful that doesn't happen, that we could see earnings from companies decline because of that. Now, in this report from FactSet, I was also able to find that the number of S&P 500 companies that have exposure to Russia, and they highlighted 10. So those companies are Philip Morris, PepsiCo, Mohawk, McDonald's, EPAM, Carnival Corporation, PVH, Westinghouse, Airbrake Technology, Mondelez Technology, and John Deere. Those are the top 10 companies with the most exposure to Russia and Ukraine. And the number one, Philip Morris International, 8% of their revenue come from Ukraine. So if there was an inability of Philip Morris to do business in Russia, they would lose 8% of their revenue. PepsiCo would lose 4%, Mohawk would lose 4%, McDonald's 4%. So it would be a hit to those companies, but it wouldn't be taking them out of business. I should also point out that what happened in the past doesn't mean it's going to happen again in the future. This could be way worse than we are expecting or anticipated, but unfortunately, we don't have any way of knowing that until after it's happened. And that is the danger with trying to predict these events. What if this turns out to be like Crimea and we call Russia's bluff and things don't escalate and the markets don't really react, and from here the market goes back up? That's a possibility. So what should you be doing? Well, you should definitely review your asset allocation. A couple episodes ago in episode 83, I talked about what the ideal asset allocation is in retirement. If you haven't listened to that episode, go back and do so, because that's a key thing to be looking at. If you haven't looked at your asset allocation, or maybe you're getting close to retirement and your portfolio is all invested in stocks or stock funds, maybe it's a good time to look at things because of the fact that we've had a really great run in the stock market. It could be time to take some profits on some of the stocks or stock funds that you own. But if you're in a portfolio that already has some money set on the side in, safer investments such as bonds or cash, 20, 30%, maybe 40%, then you probably shouldn't really do anything, because the point of you having this asset allocation is to manage the risk that you're taking. And if you only have 60% of your portfolio invested in stocks, which is still a lot, but that's what you need really going into retirement to be able to generate the income you need to keep pace with inflation, you probably shouldn't change that allocation. But it is a good time to look at your allocation and understand what your possible downside is, because I'm talking about the performance of the S&P 500. Most people going into retirement are not going to keep all of their money invested in the stock market. Why wouldn't you want to do that? Because of events like this. When you need income from your portfolio, you don't want to be forced to sell stocks when they're down. You want to try to sell them when they're at their higher levels. And if everything's in stocks and you need income now you're forced to sell a stock or stock fund that could be down 10%. And I'm talking, that's the S&P 500. There's sectors of the stock market where a company like PayPal, Facebook are down 70%. So that's where you also want to be diversified and not have all of your money in a few stocks or in just one sector of the market. That's where diversification can really help. Also, as I mentioned earlier, we don't know when the best days are going to come. And it's only after we've seen these things occur that we know what happened, right? It's easy to sit here and say, well, when Russia invaded Crimea, nothing happened. But what if that one day you sold out of your stocks and you sat on the sidelines for a long time? The longer you sat on the sidelines, the worse it would have gotten for you, because the more you missed out on the positive performance of the S&P 500, because as I mentioned, 6 months later, the S&P 500 was up 9%. 1 year later, it was up 17%. And it's really time in the market that is your best friend when you're an investor. I've highlighted in other episodes a study that was done by JP Morgan, and I'll also put a link to this in the show notes, that looks at the performance of the S&P 500 from 2000 to 2019, so a 20-year period. They went back and looked, and the average return of the S&P 500, including dividends reinvested, was 6.06%. So that's the average return per year. That's historically lower than the S&P 500 is average over a longer term. It's been closer to 10% if we go back to 1927. But if you miss the 10 best days in that 20-year period, 10 days that you missed in that 20-year period, your return would have been cut to 2.44%. Now, that might not sound like a lot, but in their example, they showed that if you had invested $10,000 on January 3rd of 2000 and you had kept it reinvested, that would have grown to $32,000. But if instead you missed those 10 best days, that money, that $10,000 would have only grown to $16,180. So significant difference in your bottom line. So my advice is to have an asset allocation. As long as your asset allocation is appropriate, you want to stick with it even during these bad times. And if you've done the right thing of having some of your money in retirement in cash or bonds, then you should have more than enough set aside that you could weather the storm. If this does get bad and things go down, that's okay, because you've got this money set aside that you'll be drawing off of and waiting for the stocks to come back. They will come back. They will go higher. They always do. And the reason why they go higher is because that part of what drives the stock market is the dividends that many of these companies pay, and also the earnings growth that companies have. You might be tempted to think you need to do something after maybe reading an article about a prediction of the stock market or listening to financial pundit on TV, but nobody knows. It's all speculation, and the best thing you can do is stick with your strategy. So I hope this is helpful for those that have concerns, and it's hard not to, over the conflict between Russia and Ukraine and possible U.S. involvement. I should also mention that I'm continuing to offer my retirement readiness workshops. If you don't have a plan for retirement or you want to get updated about what's going on with retirement planning and what you should be thinking about, consider attending my workshop if they're being offered in March. If you go to retirewithryan.com and right on the page, you'll see retirement workshops. You can find the information there of where you can sign up. I'm happy to be doing these classes back in person. So they are taking place both at Cheshire High School and Middletown Adult Education in Middletown. So have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.